Well, thank you so much, and thank you for the opportunity to speak with you all about, obviously, my favorite topic of the whole session of counterparty risk. So, this is the byproduct of purchasing mortgages is we take on the counterparty risk, and we've certainly done a lot of evolving how we think about that over the last few years. If you could move to the first slide of the presentation, this is how we've expanded it, and I'll talk through this a little bit. Traditionally, the concept of counterparty risk was very focused on the seller servicers that we interact with, and our primary focus assessing that risk was understanding the financial risk. And while that is a significant part of how we look at things and how we analyze our counterparty credit risk, we've also expanded that a little bit more. We've begun to look at things, as you can see in the buckets, it's looking at our seller servicers. That's approximately 2,000 of our seller servicers. We have brought into the counterparty family understanding our reinsurers. We also analyze our mortgage insurers. We have a team. It's an acronym. It's our core team. And what it is our boots on our ground operational exam team that helps supplement what we do from the in our offices analysis of understanding the financial risks especially. We have an entire credit analytics and reporting team that's within the counterparty family. We have our compliance and eligibility team. This team is responsible for reviewing the new applicants that come in through to be sellers or servicers, as well as the annual certifications and assessments and evaluations from a compliance standpoint, and again, ensuring that they are still eligible. We've added on quality control to the counterparty family. This is making sure that it all links together. We're looking at the credit risk that's coming in and analyzing the loans that are brought in from the counterparties and how do they fit in, how does that roll up. And we've done all this together as what we're calling comprehensive counterparty. So we take all this information together, and it's, again, not just the financial risk, but that we're in communication with our partners in servicing, with our partners in the credit world, and to have a comprehensive view of the counterparty. Something that started as a credit risk yesterday, how would that potentially turn into a counterparty risk in the future? It's not just doing the financial side of it, but also understanding are there any operational risks with our counterparties as well? So then we assign a complete view of it, and that all bubbles up to an additional framework of third-party risk management, which we are continuing to strengthen at Freddie Mac, but that also ensures that we have thought of any additional exposures that we could have with our counterparties. Do they act as a supplier in any other area? Are there any other ways that we do business with them that we need to make sure that we're brought in as we do that final assessment? So if we could look at the next slide, take a second to look at how we think of the counterparty life cycle. So as I said, first is we've got a new applicant that would come on board, and we'd review for specific criteria to make sure that they are meeting those eligibility requirements, whether they are financial requirements that may be set from FHFA that are consistent with both the GSEs. Are they additional requirements that we like to feel comfortable with that we may have looked at? We look at how long a new applicant may have been in business, their profitability. We do our background screening checks, understand strategies, make sure there's proper procedures and policies in place. Then as we look, if we do approve them, we look to set them up on our systems. We understand the terms of business. What kind of loans will they be selling with us? What limits do we need to sell on them? Are there smaller limits that we need to impose first as we're getting to understand a customer even better and as they're potentially continuing to grow? We continue to monitor this and put our surveillance on this as for all counterparties. Again, approximately 2,000 of them we have in our pipeline or our population. We can conduct ongoing financial analysis. We use a risk-based approach to understand what counterparties we're going to have the boots on the ground, our core reviews with. We set limits with those counterparties. From a concentration standpoint, from an exposure standpoint, we set limits. We look for any potential losses that may be facing those. And that's a continual cycle. And then on top of it, there's obviously risk management oversight, and if things unfortunately go into a place where we are concerned about loss or the longevity of the counterparty, we have a termination process that we follow as well. And all of this is managed through our platforms and our people that we've got, the subject matter expertise in our different divisions. within Counterparty, and some of this I'll get to in a little bit more detail in the following slides. So on the next slide, to discuss a little bit more about some practices that were in place but have been continuing to be refined and enhanced as we've gone through our recent crisis. So we kind of entered this one a little bit differently than some of previous crises in the sense that the first part of the year we had a refi boom with low rates and counterparties that were really enjoying very strong revenues, very large pipelines. And so really my team was already really engaged with these counterparties throughout this as we were ramping up to ensure that there was sufficient resources, that no corners were being cut. And it kind of allowed us to quickly adjust to then suddenly when the crisis hit, looking at things that first may have hit from a market standpoint and an economic standpoint. Now how are we going to deal with the slowdown and the changes that happen and how that translates into a counterparty risk? We continue to have very frequent daily if needed, or we adjust if it's not needed every single day to have comprehensive counterparty discussions. These, again, bring in all the different aspects of the risk to make sure that we're communicating for those who may touch it directly, to understand the financial, the operational, the credit. We've designated those that we're very concerned about into 3 different categories as we help manage this, again, using that risk-based approach, whether it's the trouble counterparties, watch list, special mention. And we've allowed for enhanced monitoring for these. We're monitoring not only the cash flow and the liquidity of our counterparties today, but what the anticipated needs are going to be in the future as we look at those that have additional forbearance loans and potentially things going into delinquency. We're also looking more closely at servicing books, not just the Freddie Mac customers, but how much exposure they may have to other GSEs and to Jenny. We've then brought into a contingency group. So those that we identified as trouble counterparties, we bubble up to develop contingency plans. Again, assuring that whether it's cross-divisional, teams within single family, anybody that has exposure to this counterparty, that we're discussing the risks and any action plans that we need from a short-term or a long-term perspective as we work through. In many cases, what we've run into over the years, and especially in our time frame right now, is it's just a matter of making sure there is awareness and conversations flowing, and things are able to be worked out through outside methods, whether that's additional financing or counterparties can have additional structuring in their place to help with any concerns that we may see, but it's a great way to make sure we're all communicating. We bring in additionally a counterparty task force that's led by our second line of defense. They help facilitate, they help challenge the outcomes coming from first line. They help facilitate any approvals that we may need from FHFA. And it helps also facilitate broader discussions as we think about changes from a divisional standpoint that may be in policies or practices, and make sure that we understand how those broader changes could impact the risks of the individual counterparties. And then lastly, you see on this slide, communication with FHFA. A lot of our large counterparties is just not exposure at Freddie Mac, but it's exposure at other GSE as well. So we are in communication with them to make sure that any potential concerns, or if we get to a point where it would be contingent actions, we could coordinate. Looking at the next slide. This gives another little bit of insight to counterparty risk management and how, from a broad standpoint, we think of things. So the first chevron you see on the slide really is thinking about how we think of things starting at the portfolio level. So annually, we go through a risk appetite process, and this allows us to set thresholds and really understand from a complete counterparty perspective what type of risk are we willing to take. We acknowledge that we need to take risks. We're not completely risk averse, but there should be limits to how much we are willing to take. So we look at things at a stress loss standpoint. That was a change a few years ago, where we're understanding the probability of default, the loss given default, and our stress exposure at that time of default. So that when we're analyzing the limit, when we're having conversations internally, when we're communicating to our board, we're really understanding the true loss that counterparty could represent to Freddie Mac. And these thresholds, again, are established and reviewed at least annually. In the middle of the page, you'll see more at the counterparty level, we're generating a risk rating internally based on a scorecard, a tool that we used, and in addition, our in-depth financial reviews. So there's a combination of various tools that we use with human judgment and human oversight. We establish management limits that are below the risk appetite thresholds that are often based on the type of counterparty, the particular sector. Are they a mortgage bank, or are they a regulated institution? Are they a counterparty? Are they a large, well-capitalized institution? Are they a smaller shop? And we set limits accordingly. We do have cushion that below where those board limits or those risk appetites are to make sure that we don't breach anything. And we review those periodically, at least quarterly. And then how we report out, the third chevron on the page. We establish KRIs and KPIs at the portfolio level and some at the individual counterparty level that really monitor for defaults in our ratings, changes in our loss given defaults. We report out on this, look for trends. If there's anything that starts to not behave as we would expect or something that shows significant deterioration, that's something that we do deeper dives in immediately. We look for activities across counterparties. Again, trends and things that stand out are big ways to handle the risk-based approach of how we choose to go into the deeper dives. And then we're also, as I've mentioned multiple times already, there's collaboration across those additional business lines. We feel very strongly that if we just looked at things from a financial standpoint, we wouldn't be taking in the complete picture, so we have to make sure we incorporate the operational risks and the credit risks as well. On the next slide, this is a slide that will show you the trends of our new applicants over the last few years. So we've broken into the tables between the banks and the non-banks. This is a question that we've gotten from other presentations, just to see trends. There's been some fluctuation, but in general, things have been fairly consistent over the years. And surprisingly, I have to admit that we're still continuing to see a strong pipeline of new applicants coming in for 2020, both for mortgage banks and for the regulated institutions. Truthfully, we had a larger probably percentage in 2019 of non-banks that we did not approve, but those were largely due to mortgage banks that just had poor financial credit trying to apply, not necessarily the sophistication and some of the reporting that we would have liked to have seen, or the failure to meet those minimum standards. And in reality, the minimum standards that we follow, again, are established for both Freddie Mac and for Fannie Mae, and so these are not things that we really have much wiggle room in. But we do review those. We make those public so that there are some applicants that we review and say, now is not the appropriate time. We can coach them to what they need to do to meet those minimums and encourage application to be handled at a later date once they're able to meet the minimums. So on the next slide, I want to talk a little bit about some of those minimum financial requirements. So what you will see here, hopefully it's not too teeny tiny for you. The middle section is labeled as current. These are the minimum standards that the FHFA has established along with Fannie Mae and Freddie Mac that hits for all our seller servicers. You'll see the minimum net worth and the minimum capital ratio. That is for all entities that come as applicants. The minimum liquidity is an additional requirement for our mortgage banks. There's also an expectation for our regulated seller servicers that they meet the requirements of their regulators, that their capital and their liquidity standards that their regulators are imposed, that those minimums have been met. On the right-hand side, what that column says is proposed. So the original financial requirements were established in 2015. The proposed changes in what is shown in red there is what was supposed to be effective at the end of this year. We worked a long time with FHFA and Fannie during 2019 to establish what we were calling Servicer Eligibility 2.0. And they went through public comment that was received. Originally, it was scheduled to be received through March 31st. That was extended when the crisis hit through April, and they were to be effective December 31st. Late-breaking news, FHFA announced that we were all putting a pause on Servicer Eligibility 2.0. And the news is so late-breaking that I can't give a complete update as to timeline for where this will stand, but the communication has begun with our seller servicers to let them know that we are pausing on this. We will be working with Fannie and FHFA over the next coming months to determine how these standards will be adjusted. I would not anticipate there being a loosening of what you see in the red that was established for 2.0, but an acknowledgement that we need to do an assessment and determine, is there anything else that should be done. So again, that communication with our counterparties has begun. There's an expectation coming from our regulators that obviously there's an adherence to the 1.0, but we're also taking a look at, is there anything that we need to do to monitor, especially those large non-banks, in the interim until the next version of the enhanced requirements come out. So there will be more details that come out of that over the next weeks and months, but again, a pause to the timeline that you see here that was just announced. So I will move on to the next slide. When we do financial analysis, what does that mean to us? So as I've indicated, we conduct baseline reviews on over 2,000 counterparties. We do deeper dives using a risk-based approach. Unfortunately, I would love to tell you that we had a staff that could do deep dives into all of those 2,000 counterparties, but that's not practical, nor is it necessarily when we have a number of tools, and a lot of them are very strong and very consistent. So we use a focus to look at those we have larger exposure to, those that are changing the risk profile, the new counterparties. We're able to segment them into areas of subject matter expertise. We have teams that are very well versed in our mortgage banks, those that understand the regulated institutions better and the potential complexities that come with that. We do automated quarterly ratings and limit update. We have built strong in-house scorecard tools that allow us to do that, to assign internal ratings. We perform reviews that affirm those ratings or limits. We're looking at approving terms of business, what types of risks we're willing to take with them. We ensure compliance with their policies and procedures. And again, as I mentioned, we've established watch lists and trouble counterparty designations that signal enhanced monitoring. That could be from moving to receiving quarterly financials, which is the typical rhythm that counterparties will submit their financial data, to targeted monthly and or in some cases during the first days of the crisis, getting daily cash flow updates. So really, once we've identified somebody as being on those watch lists or troubled counterparty lists, it kind of triggers off other things for us to have increased insight and communication internally and with the client. On the next page, discusses a little bit more into the tools. As I mentioned, we've got our internal scorecards. Using, again, the stress loss versus limit, we're looking at the true projected loss, the true expected impact to Freddie Mac if something would go wrong. In addition to our scorecards, we've got early warning tools, and those are oftentimes very focused on liquidity and cash flow. We're looking at, while we rely a lot on our internal tools, our internal scorecards to develop internal ratings, it's certainly just a tool and one part of the piece. For those counterparties that also have external ratings, we monitor those as well. I am proud to say in most times, any changes in external ratings have already been, by the time that change in an external rating happens, we've already incorporated that into our internal ratings, so it's not typically something that catches us off guard. However, we also make sure that it's a good benchmark tool. It's a good way to assess where we are in our internal assessment versus how the market may see somebody who is rated externally. We do that comprehensive counterparty view, can't emphasize that enough, making sure that we've got those other risks that we're monitoring for. And we're looking for industry trends, especially something like a time right now. We don't become so focused on just Freddie Mac customers and just changes to Freddie Mac that we go blind to other things that are going on. So we are very much looking for industry trends, even things that may happen in other credit sectors. So we're making sure that we understand changes within the Jenny book and how FHFA loans are out there and could the credit mix, and we're watching for deterioration in delinquencies and forbearance in other portfolios, because that can impact not only our credit and housing prices and everything that we're concerned about, but it also could impact our counterparties that have large exposures to them as well. We also look at not just the financial condition today, but projections. That becomes very important in a situation like we're in right now to understand the projected forbearance and what does that mean to our servicers and how they potentially need to advance money for the principal and interest or the tax and insurance. Do they have enough financing arrangements in place? Is the cash flow there? So we're projecting out in constant communication with our counterparties to make sure that there is future cash flow available as well. Quickly on the next slide, again, I've mentioned the limit setting. We're have that risk appetite that we set. We continue to define our probability of default tools. These are our internal scorecards. We go through the model governance process that Michael Bradley discussed earlier to ensure that we've got challenging, we've got history, we're validating that our tools are accurate, and we will continue to tweak as need be as we continue to collect more data. I'll switch a little bit if we go to the next slide. As I mentioned, we also have mortgage insurers in our population. PMIERS was established for mortgage insurers post the most recent crisis, and in March of 2019 was also PMIERS 2.0 that was established. And with all of this and the original PMIERS that was established and built up with the tweaks that were made with 2.0, it also has put our mortgage insurers and our comfort level with them in a different position than we felt probably the last crisis. As we continue to monitor the mortgage insurers on a quarterly basis, many of our mortgage insurers, matter of fact, most of our mortgage insurers have a surplus of approximately $1 billion over the minimum requirement. We continue to monitor this. It's a requirement, but it's also something that we pay close attention to. And just like I mentioned with our seller servicers, it's something that we do additional stresses to in our analysis. We continue to do, based on forecasts, we're consistent across how we're looking through the mortgage portfolio, how we look at counterparties, how we look at mortgage insurers, to say across the board, where do we think the potential true scenario, stress scenario, what are the forecasts to the forbearance and delinquency rates, how could that impact our mortgage insurers? And really the surplus that's been established with PMIERS has put us into a very comfortable position right now that we think our mortgage insurers are heading into this environment of employment and depending on how quickly the economy recovers, in a much, much better light than before. The next slide quickly goes into how we look to the monitoring of our mortgage insurers. We do get quarterly financial results. As I just mentioned, we do look at the PMIERS compliance on a quarterly basis. We do our internal assessment. So we've got scorecard tools we've also developed for mortgage insurers, and we have the benefit of our mortgage insurers that do have external ratings. So we're, again, comparing our internal scorecards to those external ratings. We also have our core team. That's that boots on the ground team. They also perform periodic reviews of our mortgage insurers, and it's a great way to have those conversations and just understand that the policies and procedures and the checks and balances and mortgage insurers have as well. Then on the next slide, I'll talk a little bit the next two slides, but this first one is Reinsurer onboarding. Again, Reinsurer is part of the Counterparty family. So when we look to onboard, a reinsurer, we're looking for assisting with the diversity of our reinsurers. How many do we have that are U.S. versus non-U.S.? We're only looking to onboard reinsurers that are robust and are strong financially. We do an in-depth credit analysis. We again have our internal scorecard tools to develop a rating. Some of our reinsurers have external ratings, just like the mortgage insurers. It's great benchmarking, as I've mentioned before. We meet with the reinsurers management team. We talk to our brokers. We get public and non-public information. We do the background screening, as we would do with everybody, looking at things like OFAC and background checks, and do some additional searches to make sure that there's nothing negative about them. On the next slide, you'll see something very similar, but this goes into more our ongoing monitoring. So we've brought them on board. Now they're part of our reinsurance population. What changes for this? And this is really just, again, monitoring and getting those additional financial statements, looking for any changes that could be intentional, external. We're stressing, we're looking at our reinsurers, understanding their potential exposure to things that could be happening right now with the COVID impact. We continue to look at negative news searches, make sure that there's nothing out there publicly that we feel could impact our reinsurers. We do set limits for how much we feel comfortable with any particular reinsurer, and we monitor the utilization. Are they utilizing that limit? Are they participating in transactions as we expected? And if it comes too close to the final limit, then we'll communicate that to our other teams. We also use dashboards to monitor for additional red flags, and these are for just similar to what we did with our seller services. These are particular standouts, criteria, attributes of our reinsurers that we look across the portfolio to how they're performing.